Hi everybody, welcome back to the 10th of an hour with Griffin Bridgers. For today's episode, episode 57, we're going to look at some little known life insurance tax traps. We're going to explore in particular, to bookend this, Goodwin situations or Goodwin triangles, and we're going to figure out how Goodwin situations can actually be bad losses if they're not planned around and avoided. Now, this topic is timely because with the possibility of legislative change on the horizon, especially with respect to a lowering potentially of the estate tax exemption, life insurance planning could become a more important technique to create liquidity to plan around such a legislative change. Now, as always, this presentation is not intended to substitute for legal or tax advice. Now, perhaps one of the lesser known gift tax issues I run into in my practice are the gift tax issues surrounding life insurance. And the biggest point on that is probably that any time the insured no longer has the power to change the beneficiary, what that means is that any payment of premium will be treated as a gift to the policy beneficiaries. Now, that can be a situation where maybe the ownership is changed to another person, or maybe ownership is changed to a trust, such as an irrevocable life insurance trust. And it's also important to note that since a policy death benefit will not pay out until sometime in the future, what that means is that the premium payment is usually a gift of a future interest, and gifts of future interest do not qualify for the gift tax annual exclusion of $15,000 per donee. Which is why a good planning technique here is to put the policy in an ILIT, irrevocable life insurance trust, and grant beneficiaries a crummy right to withdraw their share of contributions to the trust that are going to be used to pay premiums, because that creates a present interest that does qualify for that gift tax annual exclusion. Now, I always get the question in my practice of, why go to the trouble of setting up an ILIT? Why can't I, for example, just transfer the policy to my spouse? And the reason lies in what's known as the Goodwin triangle. If you have a situation where the owner is neither the insured nor the beneficiary, then the death benefit will be a gift from the owner to the beneficiary upon the death of the insured. So, in order to avoid this gift tax issue on the entire death benefit, it's important to make sure that in any situation where the insured is no longer the owner must be the beneficiary. For example, in life insurance planning, and we'll look at, or buy-sell agreement planning, and we'll look at how that applies in income tax as well in a little bit. And then finally, it's important to note that if you have a skip person as a beneficiary, either as a named beneficiary under the policy or in an ILIT, you also have the possibility of the GST tax applying. So, crummy powers do use the gift tax annual exclusion, but it's important to note that crummy powers do not qualify for the GST tax annual exclusion. So with any ILIT, you have to rely on either automatic allocation or manual allocation of the GST exemption every single year. Now, the ultimate objective with any sort of change of ownership in policy is to plan around the estate tax. And that's because of this onerous rule that says that the death benefit of life insurance will be included in the insured's gross estate if any of the following apply. 1, the estate is the beneficiary. 2, the insured dies holding an incident of ownership in the policy, such as the right to take loans, receive dividends, change beneficiaries, modify the policy, etc. So any retained control or benefit from the policy will be an incident of ownership. And then finally, if an insured transfers by gift an incident of ownership within 3 years of death, that rule would apply as well. And if you have skip persons as beneficiaries of the policy, there could also be a GST issue in the estate itself. So these problems can be avoided with incidents of ownership as long as you have more than 3 years that elapses between the transfer of the policy and the death. And if you don't want to run that risk, you could also have an ILIT purchase a new or existing policy. Now, if it's an existing policy, you have to beware the purchase price. It has to equal the interpolated terminal reserve of the policy being purchased to avoid a gift or estate tax issue. It may be helpful to have an overpayment in that case, and we'll look at that on the next slide a little bit as well. But it's also important to make sure that you avoid the transfer for value rule, as we'll note on the next slide, because there can be income tax issues here. Now, we've talked about modified endowment contracts in episode 43, which essentially are superfunded or single premium life insurance policies. And really what the significance of the modified endowment contract status is that it reverses the policy cash value withdrawal rules so that it will be a first draw from tax deferred growth and last from return of premium. If you don't have a modified endowment contract, that's reverse. You usually get a return of premium first before dipping into cash value. Now, significantly, not only is that order of payment reversed, but the owner has a 10% penalty tax on any withdrawals or use of the cash value prior to age 59 and a half. And it's important to note that it's not just a direct withdrawal. This could apply to any sort of benefit from the cash value, like a loan or a pledge or anything like that, that could be a taxable use, quote unquote, of the policy cash value. Now, MEC rules aside, it's also important to note that the transfer for value rule can apply anytime there's a purchase of the policy. And what that means is that traditionally, the death benefit is received free of income tax, but the death benefit could become subject to the income tax if the transfer for value rule applies, to the extent that the purchase price and cumulative post-purchase premiums are less than the death benefit. And really all that would be taxed is the excess. The purchaser wouldn't be taxed on their ultimate cumulative purchase price. Now, there are some exceptions to this rule. If the transferee, the purchaser, is the insured, or a grantor trust where the insured is the grantor, then you won't have a tax issue here. This would also apply in a situation where the transferee is either a partner or partnership in which the insured is a partner, or a corporation in which the insured is a shareholder. Note on that last point, that doesn't apply to other shareholders. It only applies to transfers between the shareholder and the corporation, whereas with the partnership, you can have transfers between partners. Now, the more difficult issues on income tax lie when you have compensatory arrangements or what's known as split dollar arrangements, and we're going to wrap this into kind of an umbrella known as premium financing. And I'm not going to get into premium financing as a strategy. I'm just going to note some tax rules off the cuff ones really here. So if you have a person or entity who's fronting the premiums, they have to get paid back their cumulative premiums from the death benefit to avoid having an income tax on the entire death benefit, kind of as a carryover from the transfer for value rule. Now, in a compensatory arrangement where there's life insurance for an employee, the premiums in excess of the first $50,000 of group coverage must be taxed as compensation if those premiums are paid by an employer. Now, in any sort of private life insurance arrangement, all the premiums are going to be subject to tax as compensation. Now, tying those two concepts together, anytime you have a situation where you have life insurance being provided for somebody else, you run into the need for a split dollar agreement to avoid these income or gift tax issues. Now, in a situation where the insured is the owner, you're typically going to have an economic benefit regime split dollar agreement where when that policy pays out, the lesser of the cumulative premiums or cash value must be paid back to the person who fronted those premiums. Otherwise, in a situation where the insured is not the owner or the donor under a maybe a private type of split dollar agreement, then you have a loan regime where you have basically a loan of cumulative premiums which must get paid back with interest over time. Now, it's also important to note that the Goodwin triangle could apply in this situation, for example, with a buy-sell agreement, where if the insured is not the owner but has the power to name the beneficiary, the death benefit could end up being taxable compensation or subject to income tax if there's no split dollar arrangement to pay back whoever fronted the premiums. So lots of things to keep in mind on the tax front. By no means is this all-inclusive. There's all sorts of things that could also pop up in terms of 1035 exchanges, use of cash value policy loans, but those are a subject for another time. Speaking of subjects, if you have questions or topic suggestions, you can email those to me at griffin.bridgers@gmail.com. Thank you for listening to this episode of the 10th of an Hour, and I look forward to seeing you in the next one.